Good morning, trading reps and clients. Welcome to today's Monday 11:15 webinar. Today we will be talking about market outlook, and then we will be going on to OUE to talk about OUE and the listing of its trust. Okay, in terms of global macroeconomics, Japan and the US, capital good orders are looking up, so this is a good sign. Lots of Japan machine orders are exported to the rest of Asia and the world. So as you can see, there's on this chart on your top right, Japan machine orders have had a huge rebound. Now, US capital good orders at a core level, excluding defense, excluding aircraft, is also on a rebound. And this bodes well for the two major economies going forward, and also for the rest of Asia. Now, China continues to slow. Exports and M2 growth were below expectations, and well, this is pretty much in line with the story that is pretty much known in the market already, that the Chinese authorities are not going to take any near-term stimulus measures. Their finance minister has come out to say that 6.5% to 7% growth is not a problem, and they are clearly signaling to the market to expect these kind of numbers. Fed minutes, no surprise, our base case still remains that tapering would be December 13, but September 13 is a distinct possibility, especially if numbers continue to be positive out of the US economy. Singapore's GDP rebounded in the second quarter. It beat expectations, mainly due to services and construction. Recovering in manufacturing was uneven, with some clusters in the manufacturing sector performing very well and some not. However, with Singapore, as usual, you have to look at the global context. And for us, the overall tone of the global economy is one that is improving, except for China, which continues to be the wild card, right? However, the overall tone of the global economy is getting better. You see better numbers out of Japan, US, and even the Eurozone. So we are optimistic for the second half, and we're not changing our basic stance. Okay, last week we talked about where we were in the cycle. And we basically think that we're somewhere around here, which is still in an upcycle, where you should be going long on stocks and commodities. Okay, so let's just go through why we think so. Okay, like I said, we think that we're in this phase for short bonds, long stocks, long commodities. And if we look at the intermarket relationship, actually, bonds are still technically on an uptrend. As you can see, that trend line is not broken yet, despite the strong selling that we have had. However, stocks are on a continued rise, and we see that commodities, which is the bottom chart here, the orange line, is held down by this downward trend line. This is the weekly charts. And if you look at the daily charts, actually commodities has actually been staging a little bit of a breakout on the daily chart. Okay, so this confirms our thesis that we are actually in a cycle where the global economy is likely to improve. Okay, because commodities are the last, in a textbook situation, commodities are the last asset class to stage a huge rally at the end of a cycle. Okay. So in the daily charts, stocks continue on the uptrend, and this corroborates the weekly. And for bonds on the daily, you can clearly see this downtrend. Okay, and we crack the weekly chart on bonds, then basically it confirms phase 4 even more. Now this chart here is a double check on the commodities daily breakout that we saw. Basically, you see the same thing for crude, which is the top black line, right? It's popping its head above that downward sloping trend line, and oil services are also going higher and have challenged this resistance line over here. Okay, so phase 4 of short bonds, long stocks, long commodities. You also see that the energy sector tends to rally. All right. So we're going to stick with our conclusion that we're at phase 4, and we advise clients to be overweight stocks, neutral or underweight bonds, and on neutral on commodities might actually be lifted to an overweight if we see things getting better. Right, it's phase 4 over there. Now let's go on to a technical analysis of the major indices. The S&P 500 is continuing its channel, upward trend in this channel. This is the weekly chart. Now on the daily chart, we see that it has broken out of this downward sloping trend line and has now challenged the high. Okay. Basically, we now need to clear the high, and then we'll have another short-term move higher. If we don't, then we might have, well, it's quite likely then we'll have a small correction. But again, if we don't break the channel, we should be trending higher. There is a little bit of an indication that we actually might have that small correction that I talked about, because on the breadth index, we have a bit of a divergence, right? So the number of stocks that are in an uptrend have decreased in a ratio, as a ratio of total stocks. However, price, we have an increase. Okay, so the long-term trend for the S&P is still intact. On the short term, there might be a small correction. Now, this chart here tells you that the S&P has outperformed vastly the STI in Hong Kong. As you can see, the S&P has, clearly made new highs, whereas the STI and the Hang Seng have been capped somewhat. However, if you look at the series of higher lows, everything is on an uptrend, including the two, including the STI and the Hang Seng. Okay, so long as the S&P 500 is continuing to rally, that's our leading indicator for the moment. And yes, we still have an overweight on the STI, and we have, we think the Hang Seng has pretty much sold to a point where valuations are very attractive. So those with a long-term perspective can start nibbling into the Hang Seng. China A-share market could be consolidating. Now the Nikkei is also still on an uptrend, and it needs to clear that high of 15,942. On the daily, we see that so long as it maintains above this level, 13,584, the uptrend is probably still on. Like we said, the Hang Seng is actually on a uptrend. If you look at the weekly chart, despite the huge volatility that we've had. On the daily, it needs to clear this, which is the 21,500, okay, to confirm another move higher. Thailand is still on an uptrend, as is the Jakarta Composite and the KLCI. Okay, for the STI, we'll go into a bit more detail for these. There's a resistance here at 3260, and the support is at 3100, okay? Now, this is the weekly chart. So this is last week, right? This is last week's chart. Previously, we said that so long as we clear this little ascending triangle here, then we should be moving towards the resistance line, which we have actually done. Okay, so now we're there, and well, basically we have to clear this 3260 to move higher. If not, then we'll have another small little correction before we trend higher again. Okay, so the overall take is that the bull market in stocks is clearly still on, in our opinion. We might have some kind of short-term correction in the S&P 500. However, I think the outlook's still positive. Thanks. Moving on to OUE right now, done by Lucas.
Okay, a very good morning to all. I'll be covering OUE and the potential listing of OUE Hospitality Trust. Okay, the agenda for today's presentation, the first I'll start with giving you guys the key details and the key terms of the preliminary prospectus lodged with MAS, which was done last week on Wednesday. Then I will give you guys an outlook for the retail and the hospitality outlook. I'll do an asset review of the two assets that's going to be placed in this potential listing of the REIT. And we will also talk about the monetarization of these two assets and the impact on the valuation. And then we will also give you guys our recommendation at the end. Okay, here on this slide, you can see the key terms. The name is OUE Hospitality Trust, a stapled group, which was it used to be Hospitality REIT management, was set up very recently to actually place these two assets within this company itself. The key numbers that you guys should look at is actually the current total offering of 434 million and about 600,000 shares or stapled securities as is named in the prospectus. This will be offered to under a placement tranche and a public offer. Another 247 million will be offered to cornerstone investors, and the remaining will be held by the sponsor, which will be about 626.8 million will be held by the sponsor. So this indicates that it's attempting to raise about $600 million or about between $600 to $630 million. Yep. The other key terms include the offering price range between 88 cents to 90 cents, and that there's a lockup for the sponsors and the managers, which refers to the 626.8 million of shares. The potential market cap will be between 1.74 to about 1.76 B. Okay, to give you guys on an outlook of the hospitality, this is a previous slide that we have used, but it shows that our assumption is constant, that the tourist arrival and tourist receipts, we are expecting it to continue to show strong growth, or rather resilient growth. The major reason behind this is that the government is actually very active on this front right now, and that also the government is trying to push for more new initiative to attract greater number of tourism in the country as well. Yep. Another reason for our optimism will actually come from the fact that the country is now targeting higher quality tourists that have greater spending power, and also from previous presentation, we actually allow you guys a glimpse into the type of tourists that we are trying to attract, and the fact that they are all their GDP for these countries that are visiting us is actually growing. So we feel that there is a case for a positive outlook. This slide shows the upcoming supply in 1-3 and also in the forecasted years ahead. With the majority of the bulk will come in 1-3 and 1-4, and we feel that it's not really a reason for cause of concern. We feel that the current performance of the hotel will continue to hold up at current levels. This will be the occupancy. And we feel that the tourism play has seen some changes to the fundamentals since the licensing and opening of the two IRs. So right now our occupancy levels is in a higher 80s, around 86 to 88% for our island-wide numbers. Yep, and we also expect current occupancy levels to sustain in the long run. Okay, for the individual asset review, this is the first asset that we placed in the REIT. It's actually Mandarin Orchard Singapore. It's completed in 1971, and there's a 99-year lease that started in 1957. We classify it as an upscale hotel, and it's currently the number of available rooms is totaling about 1051 to be exact. The RevPAR is about 243, slightly lower than the hotels in Orchard. We feel that the RevPAR will continue to sustain at current levels and show further growth going forward. We will touch a bit about that later. With regards to this REIT, okay, there's actually a fixed rent, which actually the lease that the lease is going to pay for utilizing this hotel. So the fixed, as of FY14, the contract term will actually put it at 45.0 million, and it will last for 15 years. In terms of the variable rent component, it will be about 23.5 forecasted for FY13, and for FY14 it will be 33.6 million. The proportion of variable rent to the total lease income, okay, will be about 41 to about 43%. Appraised value by Cushman & Wakefield and JLL will place it around 1.2B, which is very close to our own estimates as well. On the charts on the right side of the presentation, currently the rental income is about 75.1 in the latest financial year, and we believe that current levels will hold in FY13 as well. And for FY13 and FY14, there will be about a 3 to 5% growth, which is in line with our estimates as well. For the RevPAR, currently is at about 243, as we have mentioned previously. We believe that current levels is very sustainable. In fact, this forecasted number is slightly lower than market rate. Yep, average daily room rates at about 281, and occupancy at 86.5. This is in line with what the current hotels in Orchard are performing at. For the retail outlook, we can see that there's still continual growth in the retail sales index, indicating the consumer place in Singapore itself is still going strong. Future retail supply, you can see that 2014 and 2015, there is there's still 1314 and 15, there's still supply in Orchard, but we believe that these are just estimates number, that these supply numbers will actually be even out over the next 4 to 5 years, more so than just the current 3 years. In terms of the Orchard retail space and population, this is the indicative of what the current footfall like, and what is the estimates of the current footfall. In terms of the population and in terms of existing supply, you can see that they're more or less in line. Although we are at a point whereby our retail scene for Orchard is at a matured stage, we believe that current levels and current performance, okay, will hold the current performance of the retail place will hold at current levels. On the right side, you can see the Orchard with the retail space and the population as well. We can see that Orchard is kind of the indoor occupancy is coming down a little bit, but we believe that at current level, it will still maintain at current high levels. In terms of the asset review for the other asset within this hospitality REIT is actually the adjoining retail mall for Mandarin. It's actually Mandarin Gallery right below the hotel itself. The major asset enhancement was completed in 2009, and in the total GFA is 196,000, and NLA is about 125,000. So the key numbers to look at is actually the weighted average lease. Judging by rental income will be about 2.2 years, and by net leasable area in terms of number of years before the average number of years before the lease expires about 2.4 years, which is in other words, it indicates that current rental levels is actually kind of stable, and over the next 2 years, okay, it will follow by as per stipulated in majority of the contract terms, which we estimate to have about a 5% annual reversion. The appraised value by the surveyors will be about 525 and between 525 to 536 million. On the right side of the presentation, you can actually see that there is a breakdown. There's some typo. There's basically a second graph will actually indicate the tenant mix by net leasable area. The first one is by rental income. So we can see that fashion and apparel will take up the majority of the tenants, followed by living and by F&B and living lifestyles will take about between 10 to 15% of the remaining. In terms of valuation and recommendation, the left side will actually highlight the contribution to net property income. Our estimates have shown that in terms of net property income, these two assets will contribute 26 and 81 million in the retail and the hotel respectively. This is very close to the numbers as published in the IPO prospectus. We place it at about 27 and 75 million. Looking at in terms of contribution to net asset values, our estimates place the retail and the hotel at 540 million and 1.23 billion respectively, and the IPO prospectus is at 536 at 1 and 1.22 billion. So this is also very close to our estimates as well. Hence, we continue to hold a positive outlook for this counter and recommend and accumulate rating. The fair value, the RNAV, we are still holding it at 4.63, with a fair value at about 3.24, representing about between 15 and 20% upside to the current price level of 2.86. In terms of the REIT itself, okay, the illustrated annualized distribution net yield that is provided by the prospectus itself place it between 7.2 to 7.36%. And for the full year of 2013, you are looking at about 7% of yield. But you must do bear in mind that it's really July, and you do have to make an adjustment accordingly. For projection year 2014, at 0.88 to 0.9 share price, you're looking at 7.3% and 7.546% distribution yield, which is kind of higher than what the current market, the majority of the yields in the market right now are offering. So we are looking at a growth in distribution yield of 4.4%. Yeah. And also another key point to highlight would be that in terms of the hotel, the way the REIT is actually receiving its lease income is actually based on a fixed rent plus a variable rent. So the fixed rent is at about 45 million, and the variable rent will be 33% of the hotel gross revenue, or 27.5% of the gross operating profit. So if in the worst case scenario that such the hotel is not, the gross revenue and operating profit is not more than the 45 million, you will still see a fixed rent of 45 million at the very least, and that could potentially still provide yields of maybe about 4 odd %. Yep. So we definitely view this favorably, and that this is also a potential spin off for OUE, so that they are able to further expand into new projects or new investments itself. And lastly, we are looking at other potential spin-off. In the prospectus itself, it's highlighted that they have singled out 3 individual assets that they believe could potentially be an add-on to the current 2 assets. First is the Changi Airport Crown Plaza Hotel. It's valued at 291 million. The other 2 assets is in China. One is Meritus Mandarin Haikou and Meritus Mandarin Shantou. And these 2 will provide a further upside of about 120 to 122 million. So these are the 3 potential spin-off. But do note that currently they will have to raise further amounts if they would want to spin this off immediately into the REIT itself. As for the remaining portfolio for OUE is dominated by the office and residential, with the majority of the valuation RNAV coming from office itself. So we believe that this spin-off, the further spin-off is highly likely, considering the fact that OUE may be looking into further development projects and other investments as well. So that will bring me to the end of the presentation. Is there any questions right now? Sorry. Yes, that's right. For the REIT itself, currently, it's only just the Mandarin Orchard Hotel and the retail retail development that is right below the hotel. It's actually adjoining properties. No, they are not inside yet.
Sorry, this REIT, is it leverage? Loans?
Okay, there's a I know. There's a question from the floor saying whether this REIT is currently going to seek any debt. Okay, yeah, there is about 600 million in debt. Yep, about 600 million. 600 plus. The exact number I will have to get back to you on that. Yeah, 600 out of 600 market cap potential is about 1.7, raising about $600 million in debt. So that would be about 600 out of 230. Sorry, 2.3 B, about 600 million in debt. About 30%. They definitely did not breach the 30%. Yep.
Also, you mentioned that the assets are leasehold. So let's say, for example, I hold REIT until the leases all expire, and after that lease, I have no more returns.
Okay. There's a question on the floor. Actually mentioned the fact that if the lease is held to the date of expiration, right, and what will happen? I think that there's a lot of scenarios that can be done along the way. If I believe that you can extend the lease, if there's a top up, you can top up the development charge, top up, and also top up the lease amount, the lease number of years under the lease itself. I believe that there's a very possible scenario more so than just letting the lease run dry and returning the land and the asset to the government itself.
Usually, how much does it cost to renew the lease?
Actually, for Singapore, okay, there's a question regarding the cost of renewing the lease. Actually, it depends on the region that you're located, and also depend on the number of years and in terms of like what's the current valuation that the government has assigned to that plot of land at that point in time. So I'm unable to really comment on what it would be like in 40 plus years later. But for Orchard, okay, I will have to get back to you on the exact number that the per square foot that I can find out, and I will actually get back to you. Okay. There's a question regarding where are they leasing the land from? Currently, the land is leased from SLA, the government, Singapore Land Authority, for 99 years. Yep. Okay, that's really a lot of questions. Okay. There's a question being posted asking us to explain the difference between this OUE stapled security structure and a REIT structure. Okay, I think that this is actually a separate question. For us, this is definitely listed as a REIT. That means they will follow all the rules for listing of a REIT. That is kind of stated in the prospectus. Why is it known as a stapled security is because it's actually a holding of OUE Hospitality, which is a previous company that has set up to place the asset in, and a separate OUE Hospitality Trust Management. So it consists of the HREIT unit and one business trust unit. But in essence, in substance itself, okay, it's still operating as a REIT in which per share this stapled security will not be able to be separated. So I don't think there's a cause for concern in terms of the difference between the stapled security structure and the REIT structure, because it will still function with 90% or greater payouts. And in terms of the debt structure as well, there's a maximum of 30%, or if they were to disclose the debt security structure to you guys, they can leverage up to 60%. So I don't think there's any cause for concern. The next question, operating a hotel like Mandarin Orchard, what's the arrangement between the hotel operator and the property owner? That is, as in he's asking regarding a spread between the two of them. The percentage that the hotel operator takes from the hotel revenue and the market practice in general. I believe that this question can actually be answered with one of the slides. Allow me to bring the slide back. Okay, as can be seen here, okay, there's a fixed rent, okay, of 45.0 million from FY14 onwards. So the question previously is, the arrangement between the hotel operator and the property owner. There is a fixed rent of 45.0 million, okay, and then there's a fixed rent component, and there's also a variable rent component. And okay, I think that detail wasn't placed here. There's a variable rent component of maybe between 33% or 27%, 27.0% of. Yeah, I think it's here. Okay, there is actually a fixed rent of 45 million. Okay, and then a variable rent of 33.0% of gross revenue and 27.5% of hotel gross operating profit. Less fixed rent, whichever is higher, and obviously the variable rent is subject to a minimum of 0. So I need to say that if 33% of the hotel gross revenue and in addition to 27.5% of gross operating profit is greater than 45, then they're actually who will pay that amount. So I believe that answers the question. There's another question asking if the assets being held in leasehold property with short leases remaining for 3 years for these two assets, is it appropriate to compare the dividend yield against industrial REIT, typically assets with shorter lease balance, rather than compare with other retail REITs? I think with regards to this question, I believe that along the way, as it's running closer to the expiry of the lease, they will normally extend the lease back up to 99 years, or there may be also other options available for them. In the valuation of these assets itself, we have already taken into consideration that the number of years left on the lease is 43 already. In other words, the 1.2 B and the $536 million that we have used to value, we have already taken into consideration that it's no longer 99 years and it's not a leasehold as well. It's not a freehold. We have actually factored in the fact that there's only 43 years left. So in terms of the dividend yield, okay, you can actually compare. If you are comparing to other retail REITs, okay, it is still comparable, and we do also compare it with other industrial REIT as well, but that is more of like maybe just a benchmarking, looking at the overall performance between different types of REITs. We wouldn't really say that would be apple to apple. Yep. And there's another question regarding what is the expected yield. In the prospectus itself, the expected yield that has been provided is between 0.66 to 7.15% for full year 2013. But I think there are more indicative figure who actually if you're looking at 2014, between 7.3 to 7.46. That will actually be a full year projection. And obviously, right now it's already in July, so we can actually just adjust accordingly, which will bring the current yield, if we were to hold to the end of the year, to about 3.6, 3.5. Yep. There's another question asking whether OEE REIT has right of first refusal for Crown Plaza, Changi, and the 2-channel hotel. What's the leverage level for OEE REIT? For the first part of the question, yes, OEE REIT do have the right of first refusal for these 3 properties. In addition, for further OEE properties that is related to the hospitality or retail, that have hospitality or retail exposure, they will also have right of first refusal. The second part of the question, what's the leverage level for OEE REIT? Currently, I would believe that the leverage level is between 25 to 30%. That would be the guided amount from based on numbers retrieved from the IPO, the preliminary prospectus. Yeah. Okay. Moving on to the next question. There's a comment that Orchard is already flooded with retail. I was presuming with retail assets. Will this impact the performance of the REITs holding assets there? In our estimation, we were actually more on the conservative. We did not factor in that there will be a huge increase in performance of the retail assets. Neither do we also hold the current assumptions that just between 2 to 5% growth in terms of their hotel revenue and hotel performance. So will this impact the performance of REITs holding assets there? If Orchard will continue to be flooded, and obviously if there's a huge glut of supply that's coming in, obviously there would be an impact on the performance. However, we believe that we have already factored that in, and that the current yields are actually quite highly achievable based on current price that they have guided of 88 to 90 cents. Should we buy OEE or OEE REIT if we have a decision? This is one of the questions that is posted from one of the audience. I would believe that if it depends on the investors' profiles. If you're looking for a stable, more recurring dividends and distribution yields, OUE REIT will be more suitable for such a investment. However, for OUE is slightly more interesting because they're actually monetizing their assets, and we can see that they are aggressively trying to spin off such assets. So there may be certain upsides to it because they may actually embark on further investment, server development, and we believe that OUE will have more upsides as compared to OUE REIT, which is more of a stable, a yield play. There's a question asking regarding what will be the implication of OUE shareholders for the spin-off of the OUE REIT. This is we view this as more of monetizing the assets, and that OUE are actually trying to spin off the asset and actually take on to try to achieve to regain the ability to take on more investment and more development projects. So in terms of valuation wise, we believe that it's fairly valued, and that the implication for OE shareholders is that you can see further development and greater number of projects going forward. In terms of valuation, we do not believe that there will be a downside implication to OE current shareholders. Data read for OE to pay out 90% dividend to obtain tax-free status. Yes. Okay, there's a question to say that is it mandatory for OUE to pay out 90% dividend to obtain tax-free status? Allow me to clarify. For OUE, the developer itself, it is not. But for OUE REIT, it is. They have to pay out 90% of their net income to obtain the tax-free status. I hope that clarifies the questions. There's another question regarding what will happen when a 44-year land lease ends. Any concern with this? As I was saying previously, before the lease end, normally the developers and or the holder or the land lease holder or the lessee or rather the lessee will actually attempt to extend the lease. Okay, or before that they'll actually sell off the asset itself. I do not think that there's any concern with this. Can you come forward and actually let me see which one it is? Have you not factored in the flooded matter for assets in object? How many percent should be deducted against your estimation? Okay, there's a question from Clifford Lai. I believe that maybe I have misinterpreted your question. You say that in terms of flooded matter for the assets, as in the actual physical flooding that have happened previously before, and how many percent have I deducted this factor against my estimation? Previously the flooded area were actually upwards of Scott's area near shore assets itself. So we do not believe that where they are located currently there's a very huge factor in terms of flooding. Secondly, the current retail assets it's actually a duplex, and the area has actually been raised further, during which they were performing their asset enhancement initiative. So we do not think that this will actually be a very big factor in terms of whether you will impact the current counter's valuation. So no, we have not factored in because we do not believe that it will actually affect. I hope that answers your question.
Just a comment regarding this REIT itself. The key things about this REIT is that what is in terms of their loans, when do they, is it a fixed rate loan or is it at what point do they need to sort of, that is really the key thing regarding the second point is that because it's only a 14 years lease, so when is the break even for the shareholders? Because maybe it takes 20 years. If we get about 4%, it will take about 20 years, 25 years. Then the other 15 years, it will start taking up money to
Okay, there's a question on the floor. The first part of the question. Yeah. The first part of the question would actually be on the debt issue, whether when is the maturity for the debt securities and that they have actually taken up. So for that, we do not. The information has not been disclosed to us as yet. So we are unable to comment further on in terms of the maturity of the debts itself. There's also another key issue that he identified is regarding the number of years left on the lease of these two properties, it being only 41 years or 43 years left. So, like I was previously saying, most of the developers, okay, they will actually explore the other options before the lease ends on the 99-year mark. They'll actually look into options to either extend the lease or either further intensify the top up the lease amount. So, and also there's also potential inclusion of other assets from the parents itself. So all of these will all come into play a factor into the REIT performance going forward. Yep. Okay, there's a question asking the hotel operator had to absorb the losses if the hotel revenue in that particular period is below the guarantee level. In terms of the structure itself, yes, the hotel operator will have to actually deal with the performance of the hotel revenue, and they do have made a fixed rent of at least 45 million to the REIT itself, as in the owner of the property itself. So the answer to your question is yes, they do have to absorb losses if the hotel revenue in that particular period is below the guarantee level. However, that would actually have to be really be very drastic situation whereby the hotel revenue will even fall below the guarantee level. Yes, so I hope that answers your question. Okay, I have it here.
I have this question on the economy, right? Whether Singapore's economy will bounce back in the second half, and what sectors are we looking at to play that theme? Yes, I do think that the second half for Singapore will be better. Maybe if not in terms of the actual rate, but the quality. Okay, so the quality of the growth. Right now, MAS, or rather NTI, is still holding the range of 1 to 3. I think it'll be on the higher end of the range, maybe exceeding. Because, like I said, the global economy, in my opinion, is, well, in our opinion, is getting better. And so long as China doesn't have a hard landing, I think that that scenario will hold. In terms of the industrials that will proxy this theme, we have buys on Pan United, being the supplier of cement. So management has guided that earnings for the second half will be stronger than the first half. Okay, and we also have Bausted, which is actually going to probably REIT its own industrial portfolio, and they've also had a massive $100 million order for its industrial design and build. Okay, so I think Bausted's earnings will be good as well. And also to play this strengthening economy theme, last week we upgraded banks because banks' net interest margins will are going to improve going forward as yield on the long end of the curve is getting higher, and also there is growing expectation that the short end will be lifted by the Fed at the end of 2014. Anyway, we upgraded banks. Okay, we have more questions on OUE again.
Okay, there's a question asking for the price. I also assume it's price to book ratio for OEE. Potentially it's about 1.32 to 1.34 based on the price of 88 to 90 cents, and the total number of share of 1.308 billion, and the market cap of 1.738 to 1.764, 1738 to 1764 million. So it's a price to book value of about 1.32 to 1.34.
Hi, we have a question on tapering. Okay, how is the tapering situation now, and do you think that the numbers in the US are still good enough to warrant tapering by September? If for warrant tapering by September, I think we're going to have to see employment numbers around the 200,000 jobs added per month. We've only had 1 month of that, so premature to say that it's a sustainable trend, although our overall outlook on the US is pretty good, and I would not be surprised if that was the case. We've already had a huge sell-off over this tapering issue, so but markets have recovered, right? So actually, the signal is that equities are probably going to withstand this tapering. So personally, I would hope that it happens sooner rather than later. Then we can just move on from the issue. However, I would say that at this point in time, it certainly does look like it's an issue that might induce a bit more volatility. However, I don't think it spells the end of the larger bull market.
Okay, there's a question regarding whether the cornerstone investors shareholding will also be subjected to the lockup. The answer to that is yes. It's also subjected to the 180 days lockup, as per all the cornerstones investors, the managers, and also the sponsor itself. They are all subjected to the 180 days lockup period. And as for a request asking us to comment on SPHV as well, currently it's not under coverage. We are unable to further comment on that. Okay, and that is all for now. Thank you all for calling in to this webinar. We thank you for your participation, and we hope to hear from you with regards to any comments or feedbacks. Thank you very much.